In the following slides, we'll discuss the factors that affected stocks over the past year. As you can see, stock prices moved higher in 2024 with only a few dips along the way. I want to draw your attention to a few plot points on the graph because they highlight the key storylines that drove the stock market in 2024. The Consumer Price Index stood at 3.4% at the start of the year, indicating that inflation and the Fed would be dominant market driving factors. While the stocks took a breather in April, the S&P continued to rise through mid-July. Stock prices started trending lower in late July on unemployment concerns, but the rally kicked in late August, when the Fed publicly stated that the time had come to adjust its policy. As at the next policy meeting, the Fed cut rates for the first time in 4 years. Then in early November, election results came back decisively and quickly, which helped spark a post-election rally. By December, it was looking like the Fed had made considerable progress towards its soft landing with low inflation close to its 2% goal, while gross domestic product growth remained upbeat. Earnings are one of the factors that drive stock prices over the long term. As the chart shows, the earnings growth for the S&P 500 companies has emerged from what market watchers call an earnings recession. That is, when there's at least 2 straight quarters of negative earnings growth. As you can see, earnings growth improved steadily over the past 5 quarters, starting in Q3 2023. Although the 5.8% earnings growth rate in Q3 2024 was below the prior quarter's earnings growth, it was still very close to Q1 2024 and well above Q3 and Q4 of 2023. As consumer spending picked up in Q3 2023, companies recorded positive profit for the first time since the first quarter of 2022. We began as an earnings rebound driven by a narrow section of the market broadened over time. Let's spend a little time getting a broader view of the economy in 2024. Last year, investors and consumers cheered on the U.S. economy while also holding their breath, fearing the possibility of a recession. Gross domestic product, or GDP, started out tame but grew more robust through the year as companies continued to post solid results. As the economy kept humming, the Fed and market participants closely watched inflation. After falling to 2.4% in September, to many observers' dismay, inflation bounced up to 2.7% in October to kick off the fourth quarter. Small cracks in the economy began to emerge as the year went on. As you can see from the table, GDP growth eased slightly in Q3 and is forecast to slow even more in Q4. The unemployment rate began in 2024 relatively low, but has steadily crept up this year. Consumer sentiment started the year at all-time highs, but has fallen off a bit since then. And while home builder sentiment has fallen off each quarter since the start of the year, more inventory and lower mortgage rates have helped sentiment stage a modest rebound in the fourth quarter. Despite these downsloping trends, the good news is that many of these measures remain strong by historical standards. While the pace of inflation has ticked up slightly, it's still historically low. Consumer sentiment remains strong, as does home builder sentiment. In 2025, as the Fed has signaled its dual mandate of keeping an eye on both inflation and jobs. So expect the Fed to focus on both in 2025.